Good evening, everyone, and a very warm welcome to this Edelweiss Asset Management webinar. My name is Varun Sanan, and I head sales for Edelweiss Asset Management's Mumbai zone. With me, I have the pleasure of welcoming my colleague Niranjan Avasthi, who heads the products and marketing for Edelweiss AMC. Continuing from what we do from time to time, this is to provide great investment solutions to all our investors and advisors. It also gives me immense joy in sharing with you that now we manage over 90,000 crores of assets with 1.2 million unique investors. Moving on from there, the next in the series of enhancing our product suite, we are proud to launch 3 new funds, and all of them are index funds. And this time around, we'd like to first go with what index funds are. And let me bring in Niranjan Avasthi here. Hi, Niranjan. Let me get your thoughts on what exactly are index funds.
Okay, hi, Varun, and hi, everyone. Nice to have you all listening and watching to us today evening. So, Varun, index funds are the most simplest form of mutual funds which exist today. What exactly they do is there is an index. Say, let's take example of a Nifty 50 index. What a Nifty 50 index fund does is exactly mirror the constituents of this underlying index, which is Nifty 50, have the entire portfolio created with exactly same constituents in the same weight, and over a period of time just try to mirror the performance of this underlying index. Now, how is it different from a normal active mutual fund? Is in a normal active mutual funds, it is managed by an active fund manager who takes active calls. If it's a large cap fund, he may choose not to invest in certain stock and skip them and choose to invest maybe more in other stocks. And that is where over a longer period of time, there could be a return difference between an active fund and a passive fund. And hence I say passive funds or an index fund is the most simplest form of mutual fund, which aims to give you market-linked returns over a longer period of time.
Sure. So just to summarize what you said, an index fund is a fund which just replicates the underlying index which it is running under. There is no human intervention in terms of a fund manager selecting actively the stocks in the portfolio. And the aim is to just mirror what the index is giving. So if Nifty is giving you 12% return, the aim is not to actually outperform Nifty, but just to give you Nifty-like returns, essentially making your life a little simpler. So honestly, there are a lot of index funds in the industry, and what we see is that there are about index funds managing about 50,000 crores of assets. But how does which is in the equity side, and there are about 100,000 crores of assets with the debt side. So in this, how does Edelweiss have expertise to manage index funds?
Right. So, when you invest in an index fund, what is most important is how closely the index fund replicates the underlying index, how low the tracking error is. The tracking error is nothing but the return differential between index fund and the underlying index. So to manage this, execution becomes very, very important. While, as you mentioned, Varun, that there is no active fund manager involved picking and choosing stock, but there is a fund manager. There is a team of dealers who try to execute the trades in the index fund as closely as in the underlying index to reduce this tracking error. Now, this becomes a very, very important part. And at Edelweiss, we are leaders in fixed income index funds and fixed income passive space. And it is managed by a very specialized team. Similarly, on the equity side, we have a specialized team who looks at the efficiency of trades and efficiency of deployments whenever there are funds inflow and outflow in these index funds and ETFs, which over a period of time aims to reduce the tracking error, and that becomes a very, very important part. And time and again we have highlighted, when you are investing in passive fund, there are two costs. One is the expense ratio. The other is how closely the index fund or the ETF is tracking the underlying index and how low is the tracking error. So our ultimate aim for this specialized team who manages index funds and other passive funds is to reduce this tracking error, which ultimately benefits the end investors.
Sure. So, as we are here today, we're launching 3 index funds simultaneously. We're launching the next 50, which is minus the top 50 companies, the next 50 companies, from the 51st company to the 100th company. We're launching a Midcap Momentum Index Fund, which will essentially buy into momentum companies and of the mid-caps universe, which is essentially companies that are emerging large caps, and a Nifty 50 small cap 250 index fund, which will buy into the last 250 companies, or from the 251st company to the 500th company, the smaller companies, which will in turn go on to become some really large companies over a period of time. Now, let's first go back to Niranjan and understand what is the next 50 fund. And Niranjan, if you can just elaborate, what the fund is, how does it work, etc.
Sure. So Nifty Next 50 Index Fund is one of the most popular index fund category out there. Essentially, what this index does is take the next 50 stocks out of the Nifty 100 universe. The first 50 stocks are taken into the index, which is the mainstream index Nifty 50. And these are the next 50 stocks which are part of the Nifty 100 index. What is unique about Nifty Next 50 index is largely this universe of 50 stocks, I would say, is the most aggressive bunch of large cap stocks out there. As we all know, top 100 stocks are large cap universe as per the SEBI categorization and are present across large cap funds. Within this, the Nifty Next 50 basket, I would say, is the most aggressive. Why I say so is because most of these stocks, at least a sizable chunk of these stocks, have moved from mid-cap to this stage. And as we all know, and we will discuss that, mid-cap segment is a segment where most companies have a very high growth momentum along with them. And this Nifty Next 50, a bunch of 50 stocks, have that same momentum before they end up being leaders into their own sectors and end up being part of Nifty 50 index, which is largely index of all giant caps. So hence Nifty Next 50 over a longer period of time, you would have seen, and it will be visible in the performance, has done a tad bit better in terms of alpha generation compared to Nifty 50, mainstream index. So you get a good quality company, you get companies which are in their high growth phase, you get companies who have momentum of high growth along with them because they have been, they've been added to this category from the mid-cap universe because of their continuous high growth stage. And it adds a tad bit of more alpha to your portfolio or to your large cap portfolio, I would say. So that's broadly Nifty Next 50 has to offer in one's portfolio.
So Niranjan, is there a differential in terms of the kind of sectors also that Next 50 represents, or is it very similar to what Nifty 50 looks like?
Yeah, absolutely. So I missed that point actually. One or the other reason is also, if you look at the composition of Nifty 50 today, and it's there on the screen, almost 37 to 40% is into financial services. And that is a huge chunk. If someone is investing in that index, you need diversification. If you look at the Nifty Next 50 composition in terms of sectors, there are many sectors which are not present in Nifty 50 are part of Nifty Next 50, which is capital goods, consumer services, sectors like chemical, which is a high growth sector, and have a lower exposure to sectors like financial services or IT, which is already part of anyone's portfolio, many people's portfolio when they are investing in a large cap index like Nifty 50 or a mainstream, diversified fund also for that matter. So this sectoral diversification is also a very important, part which one gets when investing in a Nifty Next 50 kind of portfolio.
So you mentioned that the sectors are a little different. You also mentioned that a lot of these companies are high growth companies and they just burst out from being mid cap companies and into the large cap space. And there is a lot of client interest since these companies have now become larger. So does that all translate into a differentiated performance for Next 50 compared to Nifty 50? Or how does the performance spec look like?
Right, and while we can always look at static trailing returns, I would want to focus more on maybe rolling returns because it says the same story in a much more detailed manner. If you look at the 3-year rolling returns, which is there on the screen today, the average return over a 3-year period of Nifty Next 50 index is close to 13%. Whereas the average 3-year return by Nifty 50 TRI is around 11%. Even Nifty 100 TRI, which is largely, because it's a market cap based index, has 70-80% exposure to Nifty 50 stocks, has around 11% kind of return. And even the category average of large cap active funds, the average return has been around 11%. The second point is if you look at the number of times Nifty 50, Next 50 index has outperformed the other 3 counterparts, almost 44% of the time it has generated more than 15% return, whereas the other counterparts, whether it is Nifty 50 TRI, Nifty 100 or average active large cap universe, it's been around 26, 29, 27 respectively. So a consistent outperformance and also a higher chance of generating an alpha over the other options. So I think so it has been consistently displayed by Nifty Next 50 over a longer period of time, that it does generate that alpha over other peers.
Sure. The Next 50 looks like a very simple way to participate in blue chip companies, which are high growth, have a higher return potential, and may become giant caps tomorrow with a better sector representation. So clearly, from what you've mentioned, it looks like a very, very compelling solution. Let me jump into the next fund that we're launching, which is the Midcap 150 Momentum 50 Index Fund, which essentially means a 50 stock portfolio of 150 stocks of our midcap universe combined into a fund. Now, Niranjan, first, let's understand this big word momentum. What exactly is momentum?
Right. So this is a very interesting index, and as when you mentioned, let's first understand what is momentum. So momentum investing is, I would say in some simple terms, is investing in stocks which are doing well at any given point in time, in any cycle. Most people think momentum is only about investing in good companies when markets are going up. But that's not correct. Actually, momentum investing or trend-based investing is actually investing in good or companies which are doing well in both cycle, whether it is bull market or bear market. So momentum is all about catching the trend and just riding it over a longer period of time and benefiting out of it.
So clearly it are companies that are doing well and are aligned to, the greater growth of the economy. And that is why probably these stocks of these companies end up outperforming.
Yeah.
So how do we compose this portfolio? How is the portfolio made for these 50 companies? Because the universe is 150 companies. How do we arrive at those 50 momentum names?
So this index is, as I mentioned, it's a very interesting index. While, for a lot of people, momentum as a word may feel that there's a lot of complexity attached to it. But if you see, and while we will discuss about the methodology, it's very, very simple. And that's more important aspect, because when things are simple, they really work well over a longer period of time. Complexity actually, doesn't work in all cycles and longer period. So this index is actually, the universe is 150 midcap universe, which is essentially the entire midcap universe as per the SEBI categorization. And what this index does is it picks up top 50 companies which have highest momentum score and creates index out of these 50 stocks. Now, how the momentum is calculated, I'll try to explain it in very simple terms. Over here, when we say momentum, it is linked to the price movement of the stocks. So stocks which are doing well in last 1 year and 6 months, both these period momentum scores are calculated based on the price return versus or compared to their volatility, adjusted for their volatility as calculated by standard deviation. And once the combined score of 12 months and 6 months are arrived at, a combined score giving equal weight to 12 months as well as 6 months price return adjusted for volatility is calculated. And that is how we get the scores, the momentum scores for all 150 companies. Now, the top 50 companies who have highest momentum score are selected, and their weights are multiplied to arrive at their weights. Their free float market cap is multiplied by their momentum score. So what we end up getting is companies who have good momentum score or which are doing well over the last 6 months and 12 months gets highest weight, and companies who have highest market cap all along with them also gets a higher weight. So a higher market cap company, free float market cap company with higher momentum score gets the highest weight. A lower free float market cap company with maybe slightly lower momentum score gets a lower weight. So it's in that order the entire 50 stock portfolio is created, and this portfolio or this universe is recalculated, reconstituted every 6 months. So every 6 months, stocks which are doing well are added to the index and then again reviewed after every 6 months. If stock continues to do well, it will be part of the index. If it loses its momentum for some reason, it goes out of index and it makes way for a newer or for another stock which is doing well. So that is how, consistently you'll have a bunch of 50 stocks which are doing well or have done well and keep generating returns in your portfolio over a longer period of time. That's broadly, in a nutshell, how the momentum index is created.
So to simplify that, essentially, stocks that are doing well in their 6-month and 12-month time period, they are picked up and then they are just multiplied with their market cap, which is their market value in the stock market, free float, which is minus the promoter holding. And basis that, percentages are given to these top 50 stocks and a portfolio is arrived at. This portfolio is churned every or re-looked at every 6 months to see that if there are stocks that are losing momentum, you don't want to be stuck with losers and you want to weed away the losers and you want to add the new winners in. So in effect, it's a self-correcting mechanism which will keep giving you the top 50 momentum stocks from the mid-cap universe. Like you said, keep things simple. I always believe that if you keep things simple, life is good. So with that, let's just jump into some of the performance specs and see what those performance specs are. Now, on your screen, what you will see is a slide in terms of trailing returns. Trailing returns are essentially returns that if you would have invested from a time period from now, say 10 years exactly from now, what your returns would look like, 5 years exactly from now, what your returns would look like. And what you have on your screen are trailing returns for the last from 1 year to all the way down to last 15 years. Let's look at the 10-year trailing return. Look at 10 years. This momentum strategy of 50 stocks has delivered about a 26% return. Compare that to a mid-cap index, which has delivered close to a 19% return. And the average actively managed mutual funds have delivered about 18% returns. Significant outperformance. Over a 5-year period as well, clear outperformance and benefiting investors when they come into a momentum strategy. Again, similar results over 3 years and 1 year, likewise. So like Niranjan mentioned, keep it simple. And like I mentioned, if you keep things simple, life is good. It's clearly getting reflected here. In fact, what we also did was we did a similar analysis like what we showed you for Next 50, which is 3 years and 5 years rolling returns. Now, what are rolling returns? Rolling returns are essentially returns that if you would have come at any given point in time and what your average returns would be, because you can't control the time that you enter, right? You get cash flows today, you probably enter today. You get cash flows 6 months later, you enter 6 months later. So it's a mechanism which will tell you over a period of time what the average returns should look like. And when we look at the 5-year rolling return, what you clearly see is a 21% average return from the momentum strategy compared to a 14.5 from the midcap index and about a 14.5 from an average actively managed mutual funds, which, if I get my maths right, is a 7% year-on-year outperformance. Significant. And that honestly tells me that this staggering past performance is something that is very compelling for me as an investor to really look at and get it in my portfolio. In fact, as I speak, I'm really tempted to add this in my portfolio. Niranjan, but when I hear the word momentum, something automatically comes to my mind, which is that when markets correct, momentum stocks, which are really high growth companies, have done really, really well. They should fall more, right? Is my assumption correct when I assume that?
Sadly not, Varun, because that's the common misconception. And at Edelweiss, we have actually lived this because we have our Balance Advantage Fund, very unique model, which is run based on a trend-based model, which is nothing but closer to a momentum kind of model. And we have seen different phases. In fact, a lot of people have that notion that if you have a momentum based model or strategy, it will underperform during market crash. But it's not true. Our Balanced Advantage Fund was one of the lowest or least fallen fund during COVID times, when during Feb till March markets fell down by almost 38%. This fund fell down by only 15%. The point I'm trying to say is, in momentum, the idea is you get the best stock along with you, whether it is bull phase or bear phase. So in a bull phase, you will understand you will have the top 50 performing stock. Now imagine in a bear phase, when you're looking at the construction of this portfolio, you'll have stocks which have done well relative basis for last 12 months and 6 months. So you will end up having stocks which have maybe fallen less in this cycle. And that's the reason, when we look at the bear phases of this index, it is maybe probably equal to a normal market cap based index, or at times, much lower. The fall is much lower than a normal market cap based index. Some examples like COVID crisis, again, I just mentioned, from 20th Feb till March, 23rd March, Midcap TRI index, the normal market cap based index, fell 38%. This index was down 36%, almost similar. In a phase like 2010 to 11, November till December 2011, a European crisis, markets or a broader market cap based index fell down almost 39%. This index was down to 26%. During GFC, the global financial crisis, which is subprime crisis, midcap index fell 73%. This index also fell only 73%, which is similar. So at times you will see it falls similar to a market cap based index, or at times when the cycles are longer, it has actually fallen much lesser than a normal market cap based index. The point is, the recovery has been much sharper, because generally there is a notion that a fund which has fallen less will also rise very slowly when the market or cycle turns. But surprisingly, after every bear cycle, the fund has, or the index rather, sorry, not the fund, the index has actually picked up very, very well. The drawdowns have been lower and the upcapture has been much, much sharper. So while these are specific phases, we have also seen on a rolling basis how the drawdowns have been. And this, if you compare along with Nifty Midcap market cap based index, surprisingly it has at times it has outperformed on a drawdown basis, and at times it has also recovered much, much faster. So I think so, to sum it up, the belief or the myth that momentum falls higher or much more sharper is not true over a medium to long term. Yes, it can fall more within 1 or 2, 3 months till the time the portfolio is changed. It can fall, but if it's a longer bear cycle or a bull cycle, momentum as a strategy does well. And I believe most investors, when they are investing in this kind of strategy, would have a longer period of time in terms of their investment horizon. So surprisingly, it does really well under both cycle, which is bear cycle as well as bull cycle over a medium to long period of time.
In fact, Niranjan, if you can go to trailing returns, that is quite evident because, we showed you the three large falls that our markets have witnessed over a period of time. But when you look at trailing returns, one thing will come out very sharply, which is the last 1 year has been super volatile, to say the least, right? Nifty's gone from 18,000 to 15,000 and back to 18,000 and all of that. Look at the last 1 year performance of the momentum index versus the Midcap index and the actively managed funds. Again, even in the last 1 year, it's done fairly well. These results are quite staggering. But Niranjan, my last question to you on this particular fund would be, what do you think the investors' investment horizon or holding horizon, minimum holding horizon for a product like this should be?
Right. So two things. One is, it's a mid-cap universe. So usually when you're investing in mid-caps, you should give a longer period of time for you to generate returns, because at times there could be phases where mid-cap as a theme may underperform or could be more volatile. So I think so somewhere around 5 to 7 years is a minimum time period which one should look at. Ideally, anything beyond 10 years is an ideal time horizon to invest in a strategy which is linked to mid cap or small cap, I would say.
Great, fantastic. With that, let's go into our last fund, but definitely not the least that we will cover today, which is the Nifty Small Cap 250 Index Fund. Niranjan, before we get into what the product is, what are small caps and how do they benefit an investor's portfolio?
So, small cap, today when we bifurcate the universe, we have top 100 companies as large cap, then 150 companies as mid cap. And anything beyond these 250 company universe is entire small cap space actually. And if you see, 100, then 150, and this 250, the small cap universe today, as we speak, is the largest universe out there. And a lot of alpha generation ability or I would say outperformance ability is there in this universe. So small cap by quality are companies which have made their business presence felt. The products are whatever is the products or services are being adopted by investors, and they are just starting to get into a high growth phase before they get into a mid-cap universe or before they become large in their own sectors or universe. So in terms of profitability, in terms of growth opportunities, these are companies which are at a very nascent stage and have a long runway to go. If the selection and is good, I think so these companies stand a higher chance to make a huge alpha or add huge alpha to your portfolio. So that's broadly, what small caps are.
And Niranjan, how does the portfolio get formed in this one? Is there a special mechanism, or is it a very simple way that the portfolio gets formed?
Right. So broadly, the 250 companies are, as we just mentioned, are companies which are ranked between 251 to 500 companies within the Nifty 500 universe. So essentially, it gets the entire 250 stock universe of small cap. The weights are assigned based on their free float market cap, and the index is rebalanced on a semi-annual, rebalanced and reconstituted on a semi-annual basis. It's plain vanilla market cap based index. So the weights are based on their free float market cap. One thing is, important as we speak today, the small cap universe of these 250 stock has grown exponentially. A decade back, a small cap universe would have been companies with market cap from maybe 650 odd crore to 2,500 crore. As we speak today, the minimum size of this of company of small cap company in this index is close to 5,000 crore, and the largest one is around 16,000 crore. So this universe, while it is called small cap, I think so today is a universe of many meaningful businesses. Because the general notion of a lot of investors is in the small cap universe, there would be very small companies, maybe quality could be an issue. But today, because the universe is so well defined by SEBI, and with this 250 stocks making part of Nifty 500 companies, I think so these are good quality companies on a relative basis compared to the entire small cap universe that we see out there. And the size are decent, a 16,000 crore market cap company a decade back, we would have called it a large cap or a company which is just getting into a large cap. So I think so the universe is also, in terms of their impact on the sector and the quality, is improving a lot.
Sure. But we understood what the fund construct and the product is all about. But do you think it's a great time or a good time to enter into small caps, given where we are right now, in terms of, say, valuations, in terms of how stock these companies are positioned?
Yeah, I think so, because over the last 1 year, if you see, small caps, I won't say significantly, but largely have underperformed large cap and mid cap universe. If you see the return differential on a 1 year basis, if I'm not wrong, it's close to 12-13%, which is huge. And in past, whenever we have seen such underperformance, over the next 2-3 years, small caps have made a sharp comeback and they've given a decent amount of return. If you look at the valuation at the index level, of course, at the company level, the valuations could be more appealing. But even at the index level, which is maybe the simplest form of judging the valuation of each segment, small caps were trading at a significant premium to large cap and mid cap a year back, exactly a year back. Today, in fact, they are trading at a discount. The P is below 20 times. I'm talking about trailing P, compared to maybe a large cap, which is trading at 20-21 P, and a mid cap universe, which is maybe trading at the 22-23 P. So from valuation perspective, I think so they are trading at discount today after almost 2 years. And past performance has also not been that great, which makes it a good time for investors who want to start accumulating small caps. So it may not be a end to this underperformance. I would say it may continue because we can't time it. But I think so we are towards that period where accumulating in small caps could be a good time for investors to generate that additional alpha.
So I hear you. So what you're trying to refer to is the fact that we should probably stagger our investments or go the SIP way in this, which is a better way to work with it.
Yeah, absolutely.
Brilliant. Now that we know about these three funds and what exactly are index funds, Niranjan, my next question to you is, can advisors and investors combine a couple of these strategies and formulate a single investment solution? Does that work well? Or do you have any results or any analysis around that?
See, one of the reasons why we thought of launching these three together is also to drive one point that, today a lot of advisors and investors want to have their own say in terms of how much they want large cap or mid cap or small cap in their portfolio. Now, using these three index funds, one can actually create his or her own combo and have own weightages to mid cap, small cap, or large cap. And also over a longer period of time, maybe after every 2 years or 3 years, keep correcting it. You can, incrementally, you can add more to small cap if you feel small caps are trading at cheaper valuation today. You can maybe cut down exposure to mid cap at some point in time, book profits, and switch here. While there would be taxation impact, but I'm sure there are smarter ways to avoid or reduce taxation, yet manage this in a very, very beautiful way. So that's the reason we thought, we can give this combo and allow investors to create their own combos. We did some simple math. We created these various combos first combo with 60% to maybe Nifty Next 50 and 40% equally divided between mid cap and small cap. The combo 2 was simply equal weighted combo, and the combo third where you allocate 80% equally between 40 between mid cap and 40 in small cap and 20 in large cap. All these three combos surprisingly, did really well compared to a Nifty 500 index or maybe average flexi cap funds. The reason which we found out was if you see Nifty 500 universe, almost 60 to 65% ends up into getting into large cap. So there is no meaningful allocation which you get into mid cap and small cap. Also, average flexi cap universe has maybe a larger exposure to large cap. In both these options, you don't end up getting meaningful allocation. So here, you can use these three funds to create your smart combos, have your own allocation, and in a much more simpler way, and obviously in a low cost way. So advisors also, we hear a lot of advisors saying, why don't we have a higher exposure to maybe a mid cap at certain point in flexi cap? Why it doesn't keep changing? I think so here it gives them power to add their own skill set and time the allocation for their clients and get the best out of these three index funds.
Awesome. Essentially, a combo is a low cost, a low involvement, but a very effective way to actually build a long-term portfolio. But having said that, I will highly recommend that if there are any investors on the call, do not take the combo as do it yourself, because we at Edelweiss believe that it is always best to go through your advisor, because you probably don't completely understand your risk profile and the market dynamics. So it's always best to go through an advisor who will get the combo going for you as per your risk profile and your asset allocation. Having said that, Niranjan, you've provided us with a lot of information, and with this, I will now probably get the floor open for question and answers as we take some. In fact, we've got quite a few questions, Niranjan, that have already come our way. I'm just going to filter through some of them. Sure. So the first question that I think that comes out is, since we're speaking about combo, is how does a combo of Next 50 and Momentum 50 augment for a client who's looking for an alternative for a flexi cap or a large and mid cap fund? Does it work well?
Yeah, obviously, because if you see, and back of the envelope calculation says that if you look at the performance of momentum index, it has done really well compared to a normal market cap based index. So definitely that mid cap allocation will generate a good outperformance. And Nifty Next 50 also is a segment which is a bit more aggressive in the large cap segment. So both, whether it is momentum or Nifty Next 50 index, are maybe a more aggressive option in their own category, mid cap and large cap. So definitely a combo of this could, while I don't have numbers in front of me, but I believe could be a good option versus maybe a large cap and mid cap. I'll just give you an example of our own large cap and mid cap index fund, which is again very unique. Why I say unique is that index weights between mid cap and large cap are not decided based on market cap. Because the moment you decide it based on market cap, large cap allocation, ends up taking almost 60-70% of exposure. Over there also it is equal weight, which is 50-50, which is recalibrated and recalculated or rebalanced every quarter. So you end up getting meaningful allocation to both the segments. Similarly, when you're creating a combo of this momentum versus Nifty Next 50, and you even keep a simple equal weighted allocation, because you get a good meaningful allocation to mid cap segment, I think so the results could be better over a longer period of time.
Sure. I'll encourage all the participants to put their questions in the chat window. So the next question, Niranjan, is, and we've got quite a few questions around this one. some people have not understood what momentum is and how will we work with momentum very clearly. So what are the criteria, parameters, etc.? If you can just run through that again.
Sure, maybe I'll just take another couple of minutes to explain this again. So momentum is a very simple index. What it's try to do is look at stocks which have done mid-cap in the mid-cap universe, look at stocks which have done well in last 6 months and 12 months uh, and create a score based on their performance, which is called as momentum score. So in momentum score, what happens is if there are maybe 10 stocks, one stock has given 100% return in last say 6 months and 12 months combined. One stock has given 80, one stock has given 50, one stock has given 40. These stocks will be put in that order and the momentum score will be based on their past performance. If the performance is higher, the momentum score and also, sorry, the volatility is also equally lower, based on risk adjusted, they will get a higher score. So you end up getting a bunch of stocks which have done well and which will continue to do well. That's the assumption of momentum investing. And looking at the results, I think so in past it has worked. So it is simply a portfolio or a constituent combination of 50 stocks which have done well in the past, and we believe the index strategy believes it will continue to do well in the next or coming future. It is actually that simple. While we may go into formulas and all, it is there, but in nutshell, it is nothing but a portfolio of stocks which have done well and which will continue to do well. That's it. And every 6 months, the same exercise is done, and stocks which are continuing to do well are kept in the portfolio as is. Stocks which have lost momentum, which are not doing well, are moved out and replaced with other stocks which are relatively doing well.
Sure. I hope the definition of momentum and how we will run it in this particular fund or the index fund is clear to everyone. Just in case it's not, I will highly recommend you to reach out to your Edelweiss advisor and get a better understanding of this. Niranjan, the next question is a bit of a tricky one, and probably preempted this one as well, which is that if we're launching so many index funds, should it get replaced or should they replace active funds, or there is still room for active funds?
Right. So it's a very interesting question and also a heated debate over the last couple of years. When we talk about passive investing, if you look at the slide, and I would want everyone to see it, the reasons for going passive are not only whether it is alpha or not there, whether there's alpha or not. It is more about ease and simplicity as well, right? What we believe is there is definitely a room in one's portfolio to have both active as well as passive funds. Active funds will have that ability to generate alpha. There is probability that that portion can generate higher returns than the market, and that's the reason you should have it in your portfolio. Whereas the other half of your portfolio, which is passive, gives you a very simple market link exposure. It will help you when there are phases when active fund may underperform. It has to, because you take active calls on certain stocks and it may underperform in the short run. It will outperform over a longer period of time. But during that short period of time, you have this part of your portfolio which is giving you market link return. So over a longer period of time, you end up doing well in both the phases, in all the phases. Also, this other half of your portfolio is a worry-free portfolio, which I would say, fill it, forget it, and shut it. It is largely a portfolio where you may not require to review and put your energy on a daily basis or maybe a monthly basis. Even for advisors, this would be a part of the portfolio, which could be a core portfolio where you just look at the asset allocation, but not into the fund selection. And the same thing, same energy can be put on the other half, which is which active fund to choose, which to take out from the portfolio and all that. So I think so. And also another point is India is a market where there will be alpha. If you see the small cap segment or even mid cap segment, there are funds which have done well. Our own mid cap and small cap funds have actually done well over the index, over the benchmark, over a longer period of time. So I think so that is enough reason to have active also in your portfolio, and hence we believe, I think so, both passive and active have their own place in one's portfolio.
So Niranjan, just to get this argument going a little further,
Sure.
do you think it is that passive funds or index funds, if they are differentiated, which are not plain vanilla but a little differentiated, will find room as a complementary strategy in a client's portfolio? So essentially, if you're choosing 4 mid-cap funds or 3 mid-cap funds, you can have, if you're choosing 3 mid-cap funds, you can have 2 actively managed mid-cap fund and 1 of this momentum, which not just gives you diversification in terms of momentum, but also, takes the vagary the way of, say, a fund manager might get his call wrong from time to time, takes that away as well. Niranjan, the next question's another one, which is just a clarification on the fact that how are these indices formed? Who forms these indices? Does Edelweiss form them? Or is there somebody else who's forming them and we are just replicating them?
Right. So a good question. So index is always created by third party in India and most elsewhere in the world. Usually, and that's how index funds are run or passive funds are run. Index provider is very separate. So in this case, if you see, all 3 indices are created by Nifty indices team, which is part of NSE. All these indices are created independently. Some indices are, smart beta can also be co-created, but the sole responsibility of managing an index, the reconstitution of index is purely managed by a third party. So if you see, all these indices are based on one index, which is Nifty 500, the master index. Now, what constituents will be part of the index, which constituents will move out of that index? Each index provider has a very detailed process for this. There is an index committee which sits and look at each and every constituent and independently does this reconstitution of which stocks will be part and which will be moving out. So it's completely independent, completely managed by a third party. AMCs usually don't have any say in the management of the index, and rather even at the creation level, I would say.
Fantastic. Niranjan, I'm going to take one last question before we close this out for the evening. This question's around the Midcap Momentum Fund. So the question is, since it follows a momentum strategy and it rebalances itself every 6 months, there must be a phenomenal amount of churn in the portfolio, right? The portfolio must be getting churn, which essentially, for people who don't know, churn is of the 50 stocks, a lot of stocks will be going out every rebalancing and a lot of new stocks would get added. Is that also a right assumption, or the facts are a little different?
So yes, on a relative basis, the assumption is correct. Usually a momentum strategy will have a higher churn compared to a normal market cap based index, because as we saw the process, every 6 months there will be a process where top 50 stocks based on their price momentum are selected. There could be a case that out of 50 stocks, next time 20 stocks will have lost their momentum on a relative basis. So yes, the churn relative basis will be higher, but on an absolute basis it is not very high. We looked at the numbers. It is on an annualized basis it will be closer somewhere between 1 to 1.25, 1.3%, which is not very high on an absolute basis, I would say, for this kind of strategy.
Sure. Last question, Niranjan, and we close after this, which is, what is the overlap in the momentum fund versus the mid-cap index? Is there a huge overlap, or what is the overlap looking like?
So when we talk about overlap, of course, there are 2 things to it. One is the names of the stocks. Yes, the names will be similar because that's the master universe, and out of that 50 stocks will be part of this index. But what makes the difference is the weightages to these stocks. So there could be a stock which is part of Nifty 150 Midcap index, which has a weight of maybe only 0.5 in that index because the market cap size is slow, it is very low, and hence the weightage is lower. But in this index, if the momentum score or the price movement of that stock is good, it will end up having a meaningful weight here. So the stock names would be same, but the weightages, the active weights in more technical terms, would be much different and higher for a good performing stock compared to other market cap based index, I would say.
Sure. With that, I take the opportunity of thanking all of you, and thank you, Niranjan, for sending your insights on this one. The NFOs for these three funds are open. They close on the 24th of November. So I will encourage all of you to go and market these to your clients. And for investors listening in, I will recommend or highly recommend you to reaching out to your financial advisors to add these products in your portfolio. So with that, I thank you all for your time and have a great evening ahead.
Thank you all. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.